Hey everyone, welcome back to Corporate Decoder, the place where we peel back the curtain on the fascinating world of corporate finance and find out if these companies are truly singing a tune of success or just humming a tune of well. Something else today, we're diving into a very specific kind of report a company releases to tell us all about its money situation. Think of it as a financial checkup, and we're going to be the doctor analysing the results. We've got a lot to unpack, so stick around to see what Nuveen Churchill Private Capital Income Fund is cooking up. If you appreciate getting straight insights from corporate documents like this, make sure you are subscribed. We also have a Discord community linked in the description below, where we break down these filings even further. Alright, let's get into it. We're looking at a report from Nuveen Churchill Private Capital Income Fund. Now, this isn't your everyday company that sells products you can buy at the store. This is a fund that invests in private companies, meaning they lend money or buy stakes in businesses that aren't traded on public stock exchanges. It is a bit like being a private banker for businesses. So, the first key piece of information here is information about their net asset value, or NAV. Think of NAV as the true worth of the fund's investments if you were to sell them all off right now. They sell their shares on the first business day of each month, and the price they set is supposed to be close to that NAV. For Class I and Class D shares, the NAV per share as of the 30th of September 2025 was $24.45. For Class S shares, it was slightly lower at $24.38. It's a small difference but potentially meaningful for investors. Overall, the fund had about $1.3 billion in net assets. That is a big chunk of change. They also had about $2 billion in their investment portfolio and a hefty $744 million in secured borrowings. This tells us they're using borrowed money to boost their investments, which can be good if things go well, but risky if they don't. Now, let's talk about how these investments are performing. They break down the returns by different share classes. For Class I shares, the returns look pretty solid. In the last 3 years, they've seen an 11.75% return, and since they started, it has been around 11.19%. That is a good annualized return, meaning they're growing their investors' money at a healthy pace. Class S shares have a slightly different story. They started later in October of 2023. So far for the year to date, they've gotten 5.36% and a 7.97% return over the last year. Not as high as Class I, but still positive. This shows there can be differences even within the same fund depending on when you invested and which share class you hold. Then we have Class D shares, which also started in October of 2023, right alongside Class S. Their performance is very similar to Class S, with a year-to-date return of 5.89% and an 8.72% return over the past year. Again, healthy, but not quite matching the longer-term performance of Class I. This highlights the importance of understanding your investment class and its history. Moving on to distributions, this is how much cash the fund paid out to its investors. For Class I shares, they declared a distribution of $0.2. Per S share, Class S shares received $0.183 after a shareholder servicing fee of $0.017. And Class D shares got $0.195 after a smaller servicing fee. These payments are made to shareholders of record on the 31st of October and will be paid out around the 1st of December. It is good to see they're distributing income to their shareholders, which is often a key reason people invest in these types of funds. Now let's look at where the fund's money is actually invested. As of the 30th of September, they had investments in 302 different companies. This is a pretty diversified portfolio, meaning all their eggs aren't in one basket. The total value of these investments at cost was $2 billion. The breakdown of their investments is quite interesting. A massive 93.26% of their portfolio is in First-Lien debt. This is the safest type of debt for lenders, meaning if a company goes bankrupt, these lenders get paid back first. This indicates a generally cautious approach to their lending, prioritizing capital preservation. They also have a small amount in second lien debt at 2.60%, mezzanine and structured debt at 2.32%, and the smallest slice in equity investments at 1.82%. So they are primarily a lender, not an owner. And when it comes to interest rates on their debt investments, a huge 95.56% are floating rate. This means their income from these investments will go up if interest rates rise and down if interest rates fall. They only have 4.44% in fixed rate debt. This floating rate preference is something to watch, especially in an environment where interest rates can be volatile. The weighted average yield on their debt and income producing investments was 9.26%. That is a decent yield, but remember, this is before the fund's own fees and expenses are taken out, and it doesn't include investments that are on non-accrual status, meaning companies that might be struggling to make their payments. Now, a bit about the companies they invest in. The weighted average reported EBITDA, which is a measure of a company's profitability, for their private debt investments was $90.6 million. For all their portfolio companies, including those publicly traded maybe, the EBITDA was $212.8 million. This gives us a sense of the size and financial health of the companies they are supporting. Let's look at the industries these companies operate in. The biggest slice, 17.63%, is in business services. This is a broad category covering anything from consulting to staffing agencies. Healthcare and pharmaceuticals is also a significant chunk at 13.34%. Then we see capital equipment at 7.77% and high-tech industries at 8.20%. Construction and building makes up 8.29%. This shows a diversified approach across different sectors of the economy. It is not heavily concentrated in just one or two areas. And who are the top companies in their portfolio? The largest single investment is in First Call Mechanical Group LLC, which falls under capital equipment, making up 1.29% of the fair value of their investments. Matador US Buyer LLC in the energy electricity sector is next at 1.25%. Followed closely by Kenco PPC Buyer LLC in transportation. Cargo also at 1.25%. These individual positions are relatively small compared to the overall portfolio size, which as we discussed is a good sign for diversification and risk management. Now, it is crucial to remember the standard disclosure here. Past performance is not necessarily indicative of future results. This is a very important disclaimer in the investment world. While the numbers look good, there is no guarantee they'll stay that way. Also, the information in this report is based on estimates by the fund's valuation designee and might differ from their official quarterly report. And importantly, their independent auditor, PricewaterhouseCoopers LLP, has not audited or reviewed this specific data, so they aren't providing any assurance or opinion on it. This means the data here is an estimate, and investors should be cautious. Finally, the report is signed by Kenneth J. Kensel, who is the Chief Executive Officer and President of Nuveen Churchill Private Capital Income Fund. This signature signifies that the company acknowledges the accuracy and completeness of the information presented in this filing. So, what is the story here? Nuveen Churchill Private Capital Income Fund is operating as a private debt investor, focused on providing capital to a diverse range of private companies. They seem to be taking a relatively conservative stance with a heavy emphasis on first-lien debt. The returns on their Class I shares have been quite strong. While Class S and D are showing promising early results, their strategy involves a high proportion of floating rate debt, which could be a double-edged sword depending on the interest rate environment, the diversification across industries, and the relatively small size of individual company investments are good risk management practices. However, investors should be keenly aware that the NAV reported here is an estimate and not independently audited, and the use of leverage means there is an inherent risk. Overall, the fund appears to be navigating the private credit market competently, but as always, due diligence is paramount. The focus on first-lien debt suggests a priority on capital preservation, and the observed returns are generally positive, especially for longer-term investors. The main risks would revolve around economic downturns affecting their borrowers and the impact of interest rate fluctuations on their floating rate assets. Alright? That is our breakdown of Nuveen Churchill Private Capital Income Fund's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.